Welcome to this deep dive. Today, we're really digging into the TeraWulf Q3 2025 earnings call. This wasn't just, your standard quarterly update. It felt like a defining moment for them. We're focusing on this huge pivot they're making, moving away from pure Bitcoin mining and really trying to become a key player in hosting high-performance computing, HPC, for the big tech giants.
Exactly. And if you only caught the headlines, you'd probably be scratching your head, maybe even feeling a bit negative. Because this quarter was, well, a real mix. You had this optically rough financial picture. But then underneath, these massive strategic wins, really solid execution getting validated. So our job today is kind of peel back that first layer, look past the surface noise, and understand why management sounds so confident.
Okay, yeah, let's hit those headline financials straight away because, wow, they were a bit shocking at first glance. They reported after the bell on November 10th, GAAP EPS. A big miss, negative $1.13. The consensus was way off that, expecting only negative 4 cents. So quite a gap. And revenue, okay, $50.6 million. Now, that's up 87% year over year, which sounds fantastic. But it still missed what analysts were looking for, which was more like $56 to $57 million.
Yeah, that's the noise. And it's significant noise. You can't ignore it. The market reaction initially. Predictably choppy, down a bit after hours. But I think the smarter money quickly looked past those GAAP numbers. They started focusing on what really counts in this kind of infrastructure shift, that durable contracted cash flow. And what's really interesting is the non-GAAP figure, the adjusted EBITDA, that came in at $18.1 million. And crucially, that number was up 25% just from the previous quarter.
Okay, so you're saying the takeaway for investors, or the smart ones anyway, was, yeah, the GAAP loss looks bad, but hold on. The core business profitability, the actual cash flow trends are actually getting better. But how convincing is that non-GAAP number when the GAAP loss is just so enormous? Are people really buying that story?
I think they are, largely because when you actually unpack that $455 million net loss, you realize pretty quickly it's almost entirely disconnected from the company's day-to-day operational health. That huge number, it was driven almost entirely by a non-cash accounting adjustment, specifically $424.6 million tied to the change in fair value of warrants and derivative liabilities.
Whoa, hang on. $424 million just on paper because of accounting rules. For listeners maybe not deep in derivative accounting, can you simplify that a bit?
Sure, absolutely. Think of it like this. When a company issues things like warrants or certain types of convertible debt, they often have to treat the potential future obligation, like the feature allowing conversion into stock, as a financial derivative. Now, because TeraWulf stock has actually done pretty well, the potential cost or liability associated with those instruments converting, well, it went up on paper. GAAP accounting rules say you have to mark to market that potential liability each quarter. So even though no cash actually left the company, they have to record that increased potential future dilution as a massive loss right now. It's really just an accounting artifact. It's not a reflection of cash being burned or the operations failing.
Okay, that context makes the liquidity position make a lot more sense then. They reported $712.8 million in cash and restricted cash, and that's sitting against total debt of around $1.5 billion. So the cash is definitely there to fuel the build out.
Correct. Liquidity looks pretty robust, but the real proof, the validation of this whole strategic shift, you find it when you look at where the revenue is coming from. This quarter was the turning point. They booked their very first dedicated HPC lease revenue. $7.2 million actually hit the P&L. And this came from the first 22.5 megawatts of hosting capacity they brought online, mainly at their Wolf Den and CV1 sites. This is that first sort of tangible evidence that the pivot isn't just talk, it's actually happening.
And naturally, to make that pivot happen, they had to pull back a bit from the original Bitcoin mining business, right? We saw Bitcoin self-mine volumes dip, 22% quarter over quarter. Management was pretty upfront that this was strategic, yeah.
A planned reduction. Oh, very clear. This wasn't some kind of operational stumble. It was deliberate optimization. They took some accelerated depreciation, about $7.8 million, on one of the miner buildings, and they sold off roughly 8,900 older miners. Why? Well, they're actively getting rid of the less efficient machines and freeing up that valuable power capacity, not just for the new HPC clients, but also to build in redundancy and just physically make space for the new higher margin HPC gear. They're essentially trading, lower margin volatile mining revenue for higher margin predictable contracted infrastructure cash flow.
That trade-off just sounds smart, especially when you layer in the energy side of things. They mentioned improvements there too. Power prices averaged a really good 4.7 cents per kilowatt hour, and the money they got from demand response programs helping the grid that jumped significantly to $7.4 million. That lowers their cost of revenue. That points to really savvy power management.
It really does. And, those HPC margins, that's the real engine for the long-term story here. Initially, they reported 72% margins on that first $7.2 million of HPC revenue. But management clarified, look, if you back out about $700,000 in early stage setup costs at the Cayuga site, costs just related to getting that facility prepped for clients, the actual underlying operating margin was closer to 82%. Which is, that's almost exactly validating their target model of 85% margins once these sites are fully ramped and running smoothly. That margin difference alone, that pretty much justifies the whole strategic headache of pivoting.
Okay, now let's get to the part that really drove the transformational narrative this quarter, the sheer size of the contracts they announced, and the massive financing structure backing it all up. Management kept hitting this headline number, over $17 billion in long-term credit-enhanced customer contracts now signed.
Yeah, that number, it just instantly changes the perception of the company, right? It takes them from being seen as maybe a speculative Bitcoin miner to looking much more like a pure play infrastructure company in the market's eyes. And let's break down the really key deals here. We're talking about 3 big 10-year leases with Fluid Stack at the Lake Mariner facility. Those are valued at roughly $6.7 billion in total revenue over the decade. But the absolutely crucial detail, they're backed by about $3.2 billion in Google credit support. They also mentioned deals with Core 42 adding around another $1.1 billion. But it's that Google credit enhancement that's what elevates this from just a big sale to being bankable, low risk, almost utility-like revenue.
That level of credit support is, well, it's huge, but doesn't relying so heavily on essentially Google's creditworthiness introduce a massive customer concentration risk? What happens if that relationship sours down the line or Google's AI needs change dramatically?
That's definitely the key risk factor. You're right to flag it. And management sort of addressed it indirectly. They talked a lot about the partnership nature and just the sheer durability of AI demand itself. So yes, concentration risk is real. But the flip side is the fact that a company like Google is willing to put billions in credit support behind this. That signals an immense level of trust and, frankly, necessity. They need this specific infrastructure. Google is, in effect, taking some of the risk off TeraWulfs' balance sheet in return for locking down vital power capacity in a market where it's incredibly scarce.
Okay, so that long-term revenue visibility plus the credibility from partners like Google, that allowed them to put together the funding to actually build all this out, right? What was the financing package they pulled together?
They really knocked it out of the park on the financing side. Secured over $5.2 billion in long-term funding. And they kept emphasizing the rates were incredibly attractive. Specifically, $3.2 billion came from 7.75% senior secured notes due way out in 2030. That's a solid, relatively low-interest structure for this kind of build. And then, maybe even more impressively, $1.025 billion came from 0% convertible notes due in 2032, getting 0% debt. That's almost unheard of, especially for a company in a high-growth infrastructure phase.
Wow. So they've got massive dry powder now. Pro forma liquidity, cash on hand is over $1 billion. Where's that money going? What are the main uses they flagged?
Yeah, they outlined 3 main buckets for that billion plus in cash. First, providing the equity needed for new joint ventures, like the Texas one we should talk about. Second, actually buying the new sites they've apparently got lined up in their pipeline. And third, management used this phrase, building a fortress balance sheet. Which basically means they're stockpiling cash reserves to handle any future bumps in the economy and also to lock in contracts for critical long lead time equipment.
All right, let's talk about that expansion pipeline, because that's how they actually hit that huge $17 billion contracted number eventually. The Abernathy joint venture in Texas, that sounds like the model for how they'll grow from here.
It absolutely seems like the template, yeah. The Abernathy JV starts at 240 megawatts initially, but it has a built-in path to potentially scale up to 600 megawatts, all under a very long 25-year lease structure. And crucially, just like Lake Mariner, this one is also backed by Google credit support, about $1.3 billion worth. So this is the playbook. Find a site with good power access, lock in demand from a hyperscaler like Google, and then use the strength of that contract's credit quality to get cheap, long-term financing to build it. It's also worth noting TeraWulf keeps a 51% controlling stake in that JV, so they're driving the execution.
And all this confidence in the deals, the financing, the execution, led them to seriously raise their guidance for future growth. They basically shifted the goalposts for how much new HPC capacity they expect to contract each year. Went from 100, 150 megawatts annually up to a much more ambitious range, 250, 500 megawatts per year now. That's a huge jump.
It is a massive leap, and I think it speaks to two core things. One, just how urgent the demand from these customers is. They need the capacity now. And two, TeraWulf believes they have a strategic edge in their supply chain. When analysts push back on, the execution risk of hitting 250 to 500 megawatts a year, management talked about their strong relationships with equipment vendors. They claim they run this rolling 12-month forecast, which gets them basically locked in spots in the queue for critical long-lead electrical gear. We're talking the huge transformers, specialized switchgear, the stuff that's bottlenecking data center construction everywhere right now. If they really can jump the queue on that stuff, then yeah, maybe that guidance is achievable.
That seems absolutely critical. What about just the physical construction challenges for the current builds, like the big one at Lake Mariner? What's the main hurdle there?
Yeah, they confirmed that the build-out for CV4 and CV5 at Lake Mariner is moving along. But the immediate bottleneck, the critical path right now, isn't equipment, it's skilled labor. Just getting enough workers on site, they expect the labor force there to peak around March next year. So it tells you their focus right now is purely on project management, getting the right people deployed to keep those phases on schedule.
Okay, and finally, let's just touch on the demand side again. The hyperscalers are clearly spending aggressively now. But why is management so sure this level of demand isn't just a temporary surge? Why do they think it's durable?
The word they kept coming back to was massive, just massive structural demand. They painted this picture of the U.S. power grid, where scarcity of large-scale power is basically the new normal. They said getting new large blocks of power committed is now pushing out to 2027, 2028, even 2029 in some key areas. And this extreme shortage forces big power users, like AI companies, to look at less conventional solutions. Things like using dedicated island generation or converting old industrial sites with existing power infrastructure, which is exactly TeraWulf's specialty. So they see this not as a short-term boom, but a long-term structural power deficit that benefits providers like them who control generation assets. Okay, so let's step back for a second. What does all this mean for you, the listener, maybe looking at WLS stock today? This hybrid model, part miner, part HPC host, it's clearly caught the market's attention. The stock's been on a tear, up 55% over the last 3 months, way ahead of the sector. Yeah, the market's belief seems really anchored in this transformation story. This strategic pivot, it fundamentally changes the business model. It takes a company that was reliant on volatile Bitcoin prices, essentially a cyclical commodity play, and turns it into something underpinned by predictable, almost utility-like cash flows from these long-term credit-backed HPC contracts. That's the absolute game changer. So the investment thesis moving forward, it pretty much boils down to one word: execution. Can they deliver these construction phases on time? Can they keep announcing new site deals to hit that very ambitious 250 to 500 megawatt annual target? If they execute, the valuation likely continues to reflect that shift towards infrastructure.
All right, now we shift gears to our This Is Not Financial Advice segment. This is where we try to pitch an outrageous, maybe, but still plausible trade idea based on everything we just heard on the call. Given this new long-term visibility from the Google deals, how might a hedge fund analyst look at playing WULF right now?
Okay, so historically, the volatility around Willis's earnings has been really high, right? The options market often priced in something like a plus or minus 16% move just around the earnings event itself. Huge uncertainty. But you could argue this earnings call fundamentally changed the risk profile, because now the stock arguably has a much stronger floor under it thanks to that $17 billion contracted pipeline, especially the Google-backed part. But the upside potential, if they scale successfully over multiple years, that's still immense.
Okay, so high historical volatility, but maybe the downside risk is now lower because of that contracted floor. How do you trade that kind of setup?
Right. So one idea, again, not advice, is to use a synthetic long strategy. The goal is to capture that multi-year upside potential while also trying to monetize the high volatility that might still be lingering. So first, you'd look at buying a long-dated, deep-in-the-money call option. You want exposure several years out to capture the scaling story. Second, you'd pair that immediately by selling a near-term, deep out-of-the-money put option.
And selling that put, the idea there is...
It serves kind of a dual purpose. One, it tries to capture the premium decay, the theta, as that high implied volatility hopefully comes down now that the earnings event is over, the risk premium shrinks. And critically, the cash premium you collect from selling that put helps offset the cost of buying that expensive, long-dated call option. So you're essentially making a bet. You're betting that the $17 billion contract base provides a strong enough floor that the stock won't crash below your short put strike price, so the put expires worthless. But you keep all the upside exposure from the long call if they successfully grow into a major AI infrastructure provider. It's basically a structure designed to try and finance long-term growth exposure using near-term option premium.
That is definitely a structured hedge fund style pitch reflecting the new financial reality here. Okay, so to wrap up our deep dive then, despite all that GAAP noise, the big EPS miss on paper, this quarter really feels like a major win for TeraWulf. In terms of financing, locking in contracts, and just providing clarity on their strategy, it seems to really confirm their path forward as a needed player in AI and HPC infrastructure.
Well, absolutely, a pivotal quarter. But, this whole transformation story, it does raise a bigger question for you, the listener, to think about. Management talks about this immense durable demand and this structural power shortage across the U.S. But given that the grid itself is often the ultimate bottleneck, what's the realistic maximum amount of HPC capacity TeraWulf can actually build and connect each year, not just sign contracts for, but physically connect before they run into insurmountable grid limitations or other resource constraints? Does that 250, 500 megawatt annual ambition eventually hit a physical wall?
That power question. Yeah, that's probably the ultimate ceiling in the long run. Definitely something to keep mulling over as you do your own research. Thanks for joining us for this earnings call deep dive. We'll catch you on the next one.